can see now that the process of determining what to buy is data gathering, data analysis, and filtering the information. That gives us a list of companies that right now are in the right, call it sweet spot for us to make an investment and have some assurance that they're going to be around in the near term. The next part is when. When do we invest in a company? If we have a list of companies that are, call it fundamentally good, now is the when. The when is based on algorithms that determine whether or not this stock is trading at a level that we should get into it. The algorithm includes the number or the element I indicated earlier called the buy limit. The buy limit is that factor that says, okay, we want to be near the buy limit when we invest in this company, but we also need to have a more comfortable feeling that the stock price is moving in our direction. It's moving in a direction for us to be successful. So that takes some period of time. The process and the algorithms I put together, do use, I'll call it the 50-day moving average, and use the last 50 days as a key element, okay, of determining where this stock is going. I've come up with a number of formulas that look at the trend in the stock. For example, for something to be in a buy situation, it's important that we look at the last 3 trading days. Is the stock price up, 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 or is it down, down, down? We like to see the prices moving up in a short period of time. And that factors into when we say it's time to send out the buy alert. So the when is based on, again, a set of mathematics, based on stock history, what's happened in the stock over the short term and the long term. It's a combination of both. Looking at the probability of this stock achieving a certain price in the near future, because that is the name of the game. We want to buy something that's going to hold its stock price, not going to deteriorate significantly. We don't control the market, so it's going to go up and down, but we want to make sure it doesn't go down a lot. We don't need it to go up a lot. What we need the stock price to do is to be stable over the next period of time when we're going to make the investment, because we're basically going into the options market. I want a stock price that doesn't fluctuate, or I get hit with a surprise that goes down 10%, 20% tomorrow. So if we understand that we've got good fundamental principles in the what, and the when says it is time to buy, then we should be on the right side of the I'll call it the trade that gives us a high success rate. Because with those factors now, we've done away with a lot of noise, we've done away with a lot, let's call it emotion. And that's the other thing. These, I'll call it algorithms, don't have any emotion. The key is a lot of times people get emotionally tied to their stock positions. They say, well, I'm never ever going to sell Apple. Well, that's fine, okay? But look at what is the opportunity you're leaving on the table. The Apple stock price has gone up and down, and if you did buy it and did exit Apple at the right time, got back in, you would do significantly better than if you just bought and hold forever. I mean, some people can do that. They have a lot of assets. Other people can't. It's been my feeling that if you want to generate a constant income and return, you need to take on positions, exit positions, and use the opportunities that are presented every day to generate a really nice return in income for life on assets that you own. So that's key. So the when it's a complicated process. You don't need to know all the details. You just need to realize that the numbers are crunched every night. So this is a process that doesn't just happen once a month or once a year. It happens every day, because what environment we're in. We're in the environment stock prices change every day. In fact, they change every second. We're looking at a daily basis, basing the decision on when to buy, on that I'll call it end of day price, and looking at that back in time to find a way or give us a way to look forward. It's all about the future, okay? This whole business of, well, I shoulda, coulda, woulda, shoulda done it, doesn't get you ahead in life. You need to understand what's going to happen tomorrow. And that's what the algorithms are designed for, is kind of to look forward and use mathematics, probability of what's going to happen tomorrow, and get that on your side, to give you that advantage, to give you the comfort factor. And all of this now is key because, it's a lot of, I'll call it math and technology, trade technology executing in the background. The key is you don't even have to worry about that because it's all done for you. The done for you process executes the algorithms, puts those opportunities in front of you. So now that you should have a very good comfort factor in going ahead and doing those trades just like we're doing them. And that's key. Okay, if you try to second guess the data and the system, I suspect that you will not do as well. Okay, I don't know of anybody who's been able to outsmart the data that we're presenting. Sure, some people get lucky and say, well, I didn't buy it exactly that day. I waited till the next day and I made a lot more money. That's great, okay? But also tell me when it went against you. In other words, everybody always tells you how well they did, but they never tell you when they did poorly, okay? That they always forget about. So I think it's better to look at a continuous process that generates opportunities that are very successful based on the data, based on the results. And the results, speak for themselves. Win rate is over 95%. And that's key because if we can, if you can maintain that type of win rate, then you can sustain some losses. You can have some issues where they do go down. If you get out of them break even, we're still going to be way ahead of the game over time. And so you should have now a comfort factor of the fact that all of this mathematics and algorithm stuff is going on in the background. You really don't need to know all the nuts and bolts about that because it's complicated. And even if you understood it, I don't think you can add any value by saying, well, I don't understand, or let me look at this differently. You have to be, I'll call it pretty sophisticated of being able to add additional, call it value to the process. There may be a few elements that you have been successful with, and sure, I would say add them to your decision box, okay, to your decision tree. And that's good. If you can improve the result that we're having, fantastic. But don't assume that you're saying, well, I'm going to re-engineer, I'm going to re-look at everything that's being presented and don't trust it. I think in the long run, that'll go against you. You're better off trusting the data, following our footsteps, and taking the data from the system and using it to your advantage as it's presented each week.